Hi everybody, hope you're well, hope you're fantastic. My name is Gavin Mkabela. Now today I wanted to talk about a dear client of mine, Sarah. Now Sarah came to me a couple of months back after seeing one of my videos where I was talking about the fact that a lot of people are sitting with property that have equity and they're not doing anything with that equity. I even call it lazy money because that equity is not giving birth to other money babies. So Mom Sarah reached out and said, Gavin, I think I'm one of those people. So anyway, we did a free consultation. We sat down with Mom Sarah and we did a needs analysis. So upon doing everything else, we realized that actually Mom Sarah could potentially refinance 1.5 out of this particular property. So this property was financed by the bank and Mom Sarah was almost, on the brink of paying it off. So then we then saw that at the end of the day, there was money in this particular property. So 1.5 was the amount that Mom Sarah could potentially refinance. Now, how did we do this? Of course, we did this through pre-approval, right? So we can see exactly where Mom Sarah was sitting at. Cool. So then Mom Sarah is like, wonderful. So what do I do next? So I want to now take you through what we did. I'm gonna make it visual so that you can definitely see what I'm talking about. So let's go back, right? So here's Mom Sarah. So Mom Sarah is coming to us and say, Gavin, I have a property, all right? This property that I own and I'm almost, done with the bond. So almost finished paying off the bond. All right, cool. So then Mom Sarah says, all right, Gavin, what can I do with this? Because at the end of the day, yes, I'm almost good. I'm gonna finish paying off this property, and I'm doing okay in life, but I wanna do great, right? I wanna have passive income, so I wanna make money while I'm sleeping, right? So what do I do with this particular property, right? So as I said, we then did a pre-approval, all right? So we did a pre-approval that now shows that Mom Sarah can get 1.5 million from this particular property. So she can go and refinance the 1.5 million, right? So remember that there's two types of refinancing that you can do that I talk about. So one is refinancing on equity. So remember that Mom Sarah has been having this property for the longest of time. So she has paid in a lot of money to then be able to settle, the bond. But another thing we realized that this particular property has appreciated in value. Right, so meaning the value of the property has gone up. So those are the two sides of the coin that you normally would work with when you refinance, right? So in Mom Sarah's case, is both of them. So she has been paying a lot, paying fast forward into the property, paying more into the property, and this particular property has appreciated in value. So it then gives Mom Sarah 1.5 million as we do the pre-approval. So when you're refinancing, it means that you take what you already paid into the bond and in terms of what the property has appreciated by. So we took both of those two things and then we came to 1.5 million. So that was great. So Mom Sarah's like, wow, I've been sitting with 1.5 million. I was like, yeah, Mom Sarah, you are a millionaire. All right, wonderful. So cool. So then what we do after that, of course, we now have a figure of 1.5 million that we can play around with. And then when Mom Sarah came to us, she was toying around with the idea of investing. So there's a couple of properties that she's seen. And then of course we had a couple of properties of our own that we could present to Mom Sarah. So through all of that, we made the analysis and we find out that actually Mom Sarah can then get out of all of this 3 more properties that she can buy cash. Imagine that, right? So remember that we are now working with 1.5 million, right? So we had a budget of 1.5 million that we can then play around with. So this was 1.5 million that we can play around with, which is fantastic, all right? So cool. So now through this 1.5 million, then we saw these 3 properties that we can then buy, right? 3 properties that we can then buy through this 1.5 million. Sorry for my writing. So we had 3 properties that we can buy. So remember that there's still this one property that we have. All right. So this is the one main. So this is the primary property of Mom Sarah. So this is the property that we are now squeezing the money babies out of, right? And then we are able now to buy the 3 properties cash. So remember, this is cash. Cool. So this is where Mom Sarah is staying. Of course, there's no income. And here we are now getting to get rental income, right? So we're going to get rental income on all these 3 properties. Cool. So now when we then did the analysis, out of these properties, 2 of them are multi-tenanted. And remember now, because Mom Sarah is now paying cash, now is buying these properties cash, then she had the leverage of negotiating, right? So she could even negotiate below market value because of the cash that Mom Sarah had. So power of negotiation, which is fantastic. And 2 of these properties were multi-tenanted or are multi-tenanted. So meaning that there's more than 1 tenant in that property. So that means multiple income streams from those properties. This other one is a sectional title. So it's an apartment. So we bought this for a future perspective because we want the capital appreciation, right? So remember that when you are investing for the long term, one of the things that I normally recommend is that you look at both cash flow and capital appreciation, because the nice thing about it is that when we look at cash flow is where we talk about liquidity, right? So you'll be getting money, cash flow coming in every month. And then from that capital appreciation is where now we'll look at the future. We say, all right, we'll see this property, we see this area, that is doing very well. And in the future, we might, in the next couple of years, 2 years, we might see a nice capital growth coming in that particular area. So that's how we did it here. So we were able to use that to say, all right, when that property appreciates in value, then we're gonna squeeze out the equity, then we're gonna refinance again. The same thing that we are doing now. Cool. So then we are sitting here, it's like, okay, fantastic. So Mom Sarah is very happy. I love it. So remember now, Mom Sarah is going to have 4 properties, right? 4 in total. 3 out of those came from this one property. Did she need to do a lot of things? No, she didn't. So she used the power of leveraging, and that's exactly what got her to 3 more properties that now she has. And then remember, these 3 are now producing income. There is money machankurana, right? So there's income that's coming in from these 3 properties, and that's where exactly Mom Sarah is. Cool. So Mom Sarah is loving this. Cool, Gavin. So now let's get the ball on the road, right? So let's get this ball rolling. I want to get these properties. I want to be a property investor. For the first time, Mom Sarah is now becoming a property investor. Cool. So before we then buy, Mom Sarah, through our consultation, Mom Sarah mentioned that she had 3 kids. Right. So one of them is older and is about to get married, and apparently, the boy is in love and it's community of property, right? So Mom Sarah, through our engagements, like I'm building all of this for my children and their children and their children's children, right? So I want to make sure that this is a legacy thing that I'm building. And remember now that a lot of us, we become the first in our families to do things like this, right? So we become the first to create this legacy aspect of generational wealth that is starting to kick in. So Mom Sarah is that person, says, I want to do this for my children, but I also don't want to, to just, make this thing in a sense that, they get married. Now this one is going to get married of property. I don't want to have a situation now, then this legacy that I'm creating can be affected. I'm like, no, don't worry, Mom Sarah, we got you covered, man. We got you covered. So then what we proposed was like, Mom Sarah, instead of buying these properties in your name, rather buy them in a company and a trust. Right? So then we open a company for Mom Sarah, okay, and then we open a trust as well. Cool, which was fantastic. So through that, we are now saying, Mom Sarah, your family trust that we are opening is gonna now own this property this company 100%, so that whatever that is owned by the trust does not then stay in your personal state, right? Because remember that there's 3 main entities that we use to buy assets. You have your natural state, which is Gavin. You have a company, Gavin's Pty. You have a trust, maybe Gavin's family trust or property trust, whatever you want to name it, then you have that, right? So those are the 3 entities. So this other entity, which is Gavin, the entity, it means that Gavin is going to die. Unfortunately, we are all going to pass away. So when we then have passed away, whatever that we own in our natural state, right? So I have these assets that I have in my natural state will now need to be transferred to somebody else, being maybe my kids, my spouse, whoever I nominate as beneficiary, right? So that will definitely happen. So because I'm no longer there, so I'm an entity that will never forever exist again, right? So that's the case. When we pass away, we pass away. Whereas company and the trust are entities, yes, they can fade away if somebody deregister them or whatever the case, but as long as they're there, somebody reviving them, they'll be there forever and ever, right? Yes, cool. So Mam Sari says, okay, I love that. So it means that these properties now will be protected in the trust. And remember, there are two main trusts that we work with, right? There's testamentary trust. So this is the one now we had to also look in through our financial planners to help Sarah to say, because there is a minor child, right? Now, what happens to these assets and everything else when Mam Sarah passes on, So obviously you still need a will, right? So I recommend that you do have a will. So our financial planners and our attorneys can help Sarah with that. And then, of course, the testamentary trust was something that Sarah could also look into to say, I have a minor child, So these other ones obviously are all a bit older, but I want to make sure that this particular child that I have, the minor child, that, there will be people that can help to administer the finances until she is a bit older. All right. So then that's where we looked at the testamentary trust. That's the one that is attached now to your will. And then the one that I'm going to be dealing with now is the inter vivos trust. So this is the one now that is an entity that can buy assets, store assets, and then in this case we are storing the assets, which is very, very important, right? So we open these two trusts so to make sure that at the end of the day, Mamsara is protected. Mamsara is protected through this because now whatever that is owned by the trust doesn't form part of Mamsara's personal estate, all right, which is fantastic. So when now she's passing away, right, the only thing that happens in the trust is that her name will be removed and then the children will now take over and become the trustees, right? But then, the nice thing about the trust is that you can have certain clauses that then protects, the children and then the assets and from a generational wealth perspective. So you can rule from the grave, basically. So you can do that. So that's what we did. Mam Sarah was happy. The protection, because now the older child getting married in commute of property. If something happens, I'm not saying that we don't want things to happen, right? Well, one of them is going to happen. There's two things that might happen there. Well, there's one, it might happen, and then the other one is going to happen. So you might get divorced. The other one is that it's going to happen that we're all going to pass away. So obviously, Mam Sarah as well at some point will pass away, and then what happens now to these assets? So it obviously they need to now move over to the kids. And what happened now if, let's say, the older one gets divorced and married off communal property? So those are the things that we started to negotiate and discuss and see how we can help Mam Sarah. And through all of that, we then came up with this amazing sort of combination of then putting the trust and the company together to help Mam Sarah. So we did that, which is great. So we then bought. So remember, when you do this, is that the offer to purchase is now being done under the company, right? So the company is the one that transacts in this whole process, and all of this rental income that will be flowing into the company. So nothing goes into the trust from an income perspective, because if we did that from a tax point of view, now you have double taxation, because then the company is 27% and then the trust is 45%. So if now there's an income that is already taxed at 27%, now you move it over to the trust, maybe paying dividends, it now means that you're now going to be paying 45% tax, which doesn't make sense, right? So everything happens here. You can also take out money through the company, maybe pay yourself a salary, director's drawings, whatever the case might be. And that is why having an accountant will also assist very, very much, right? So we have all the power team in-house. We have accountants, we have attorneys, we have financial planners. That is super, super great, right? Cool. So then we help Mam Sarah through this. And remember now, at the end of the day, when now Sara is buying through the company, she's creating a financial history for the company, a financial health kind of perspective or personality for the company. So this company in a number of years can then go and get a bond, without Sara playing the bootstrapping kind of role where they now need to use her salary to then get the bond. She can just use the company's financials because it will be great. And remember that we bought the 3 properties cash. We bought them cash, right? So there is no bond there. So that's exactly what we did. Now through this, now the older child wanted also, to just be able to get more business out of it. So Mam Sara could help through this company to then be able to start an Uber business, So through this, there would be a pay slip. So basically what happened is that the older child could be employed through the company, right? And through that can be able to use the pay slip to then get a car, an Uber, put it on the online, and through that make money out of that. Now, the child is having about 2 cars, and through those cars are Uber business that was given birth through this particular company. So there are many things that you can do. So as you can see, there is power in using the equity that you have in your property to then be able to give birth to more properties. So imagine Mam Sara, from just 1 property, she now has 3 more properties, and those particular properties are paid cash. So the one of those properties is now servicing the bond, because remember now she has refinanced, the bond is higher, so one of those properties is now servicing the bond. Imagine that. Then the 2 is free money. It's free cash flow that she's getting every single month. Every single month she is getting free cash flow, and you can do the same thing as well. So if you want to learn more, if you want to see how you can do things, please reach out to us. You can call us on 074 412 7614. 074 412 7614. Right? Or you can send us an email on info@gavshaw.co.za. So Gavshaw is GAVSURE.co.za or www.gavshaw.co.za. I can't wait to help you, and so that you can be even better than Sara. Cool.